Ladies and gentlemen, good day and welcome to the KFin Technologies Limited Q1 FY25 earnings call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Devesh Agarwal from IIFL Securities. Thank you, and over to you, sir.
Yes, sir. Good morning, everyone, and welcome to the Q1 FY25 earnings call of KFin Technologies Limited. From the company, we have Mr. Srikanth Nadella, the MD and CEO, Mr. Vivek Mathur, the CFO, and Mr. Amit Murarka, the Head of Investor Relations. I would now hand over the call to Srikanth for his opening remarks, which will be followed by a Q&A session. Thank you, and over to you, Srikanth.
Very good morning, Devesh, and thank you so much for all the participants. I'll kickstart with very positive news in terms of the Q1 results of our organization. Many of you might have already seen the results that have been published, the highlights and the headlines largely reverberating our continued focus and commitment to all our stakeholders, our shareholders, our clients, our employees, our regulator, to continue to deliver excellent value quarter after quarter. The headlines, of course, are year-on-year growth across the important metrics of revenue growing at about 31%, EBITDA about 42%, and the PAT numbers growing at about 57%. These numbers also highlight a very important trend, which is typically the quarter one in our industry is usually marked with a certain amount of slowdown. Even the Q4, which is usually a very, very high energy quarter, both in terms of the client wins, the revenue that's booked, and the market buoyancy, usually tends to slow down a bit in Q1. But this quarter is a significant deviation from that standpoint. Our revenues even sequentially have grown 4%. But of course, the margins are expected to take a dip given the wage inflation and a reset of certain contracts that typically happens on 1st of April. An organization with over 5,500 employees, one would expect there would be a certain amount of slight hit. But of course, as we have always seen over the past decades, Q2, Q3, Q4 will continue to outperform. Significantly even at the margins level. If you see this quarter, we have delivered a 42% EBITDA margin, and this, if you were to compare with Q1 of previous year, it was 37%. So that's a healthy 500 basis point expansion in the operating margin in this quarter as compared to the previous quarters. This quarter also for us marks a very important quarter from the standpoint of market share expansion across the business units. Mutual funds, for example, we have seen our overall AUM market share at roughly 42% as compared to 37%. So that's a big expansion in terms of the overall AUM for the company in terms of the client's performance. This would augur significantly well in the context of a series of NFOs that have been lined up across our clientele in the upcoming quarters. Yield too had been maintained at a very steady rate as compared to all the previous years, continuing with our commitment in terms of delivering high quality revenues in comparison to the assets that are under management, for our clientele. We have won near about 280 clients in corporate registry, our second largest business. Very, very proud of my team's execution capabilities in terms of having won what could be the largest IPO in India, that of Hyundai. The earlier largest IPO, LIC of India, was also delivered by KFin Tech. Also a series of other wins across, including Pine Labs and others, but again, through its 270-280 clients, speaks volumes in terms of the growth traction that we have, especially in the large IPO markets. We have a series of IPOs that are going to go public. Now, winning a mandate doesn't necessarily translate to an immediate revenue gain, because the mandate needs to be translated into an actual launch of that IPO. We are expecting in the coming 2 quarters to 3 quarters a significant number of our mandates that we have already won to go public based on the DRHP filings that we have seen. Next, the alternatives, we continue to see a massive amount of traction, having increased our revenue year-on-year by nearly 60%. Our AUM has crossed $1 trillion, and that augurs really well in terms of our overall growth. And a series of the funds that we have already won, where the capital had been drawn down to a certain extent. There is a significant gap in terms of commitment versus drawn down capital, which augurs well in terms of the rest of the year's revenues to kick through, even as a series of wins that we've had this year positions are exceeding really well into the coming year as well. The business that most of us are also keen had been the international. We have seen significant green shoots in the international markets. The mark-to-market gains the last few years, as we have all noted, have been bit to bit, while the Indian markets have significantly outperformed. Many of the Asian markets haven't. But over the last 2 quarters, we have seen a turnaround in the markets with the major market positioning in Malaysia and Philippines, etc., where we are present. Mark-to-market gain coming through. Many of the wins that we've had, the transitions completing and going live. We had already gone live. The first contract that we had in Thailand in the month of April for the first phase, and the second phase will go live into the next quarter. Also very happy to inform a large contract sign-up that had happened in addition to probably what could be the largest contract which sign-up that we're expecting sometime today or tomorrow based on the draft LOA that had already been signed and sent to us. This had been largely the businesses, the key businesses, the national pension system. Small yet what I think would be a very, very important business in times to come, especially in terms of margin profiling. The industry grew at 12%. We continue to outperform the industry by a factor of 2, a little over 2. We grew at 27% in the case of pensions. And our commitment to deliver very high quality tech solutions, which aren't able to be delivered by any of the other technology or other intermediary companies, is helping us to win significant amount of traction in mandates towards data lakes, the digital solutions for the asset management industry. This quarter was no exception. We had 1, 2 such contracts, and we are hoping to expand that positioning significantly well. Many of our acquisitions have posted stellar growth of the tech company we bought, whereby technologies had grown at double the year-on-year revenue, even as a significant number of gains are coming through our fund administration acquisition of Hexagram. Our M&A strategy continues to be a very, very critical one. We are currently looking to add one of the acquisitions in the coming quarter based on the current stage at which we are positioned in terms of the contract negotiations. We are obviously extremely bullish and with the continued mutual fund expansion in the country. As we have all seen in just a matter of 7 to 8 months, mutual fund industry had grown from 500 billion to about 600 billion thereabouts, and that just speaks volumes in terms of the resilience this particular market has. The SIP inflows continues to be extremely strong. We are continuing to have equal or better market share in each and every one of these segments, whether it's the overall AUM, the SIPs, the NFOs, the folio creation, so on and so forth. Q1 of this year, especially had been a far better quarter as compared to the previous 5 quarters, and this trend we expect to continue in the foreseeable future. The demat account expansion too had been pretty solid at about 32%. All of these have resulted in our issuer solutions revenue to grow quite substantially in the previous year, as is the case with this current year as well. Typically, as I said, Q1 is a little tepid here, but happy to note that we crossed 20% plus revenue growth even in issuer solutions, which points to a much better Q2, Q3, Q4, as many of the corporate actions on the corporate, the dividends, the buybacks, the demergers, so on many of these transactions will come through starting this quarter onwards. In terms of the expansion, just a little bit into the international, we today stand at roughly about 75 contracts in the Asian market. With the issuer solutions on the RTA weighted at about 45 and the fund accounting and the administration solutions at about 30. We have added a sizable number of clients, 12 clients in the past 12 months, and we believe that based on the current pipeline, a significant expansion would happen into the rest of the quarters, even as the 2 large wins that I spoke about, pretty much are materialized in the last 4 weeks alone. The overall AUM expansion and the transaction volume, while the transaction volume is low, we all know that the international markets offer pound to pound a significantly higher AUM per transaction, which also augurs well in terms of the operating margin leverage that would kick in, as the quantum of effort required to deliver to the same transactions is far lower as compared to what is here in India at the moment. With that, I would hand over quickly to cover the financial performance to our CFO, Vivek, and we will take questions post-which.
Thank you, Shrikant. So you've got a flavor of how the business performance has been in the last quarter versus last year. I'll cover the financial performance. The revenue from operations went up year-on-year by 31%. Within that, the domestic mutual fund growth was little more than 34% year-on-year and 8% quarter-on-quarter sequentially. Even the VAS revenue has seen a growth. It is now about 5.5% of the total revenue. And, there is a substantial jump in terms of the overall VAS revenue by almost 50% year-on-year in this quarter versus last year's same period. On the non-domestic mutual fund business, the international and other investor solutions has seen a robust growth in terms of revenue by 56.8% year-on-year and about 11% sequentially quarter-on-quarter. And it is, both driven by the Southeast Asia business growth led by increase in AUM and new client materialization of revenue, and AIF and the PWM PMS segment, which is growing at almost 65-66% year-on-year. The Hexagram acquisition that we did has really contributed in terms of sale of platform and implementation of this, the platform along with the services that we offer, 80% growth year-on-year and almost 54% growth sequentially in terms of revenue. Issuer Solutions has seen a growth of 21.7% year-on-year for the reasons Shrikant explained. We have one number of IPOs and migration of clients from other RTAs to KFin Tech, and because of the seasonality impact of corporate actions and dividends and bonus, coming quarters will see growth quarter-on-quarter. While this quarter sequentially on Q4 may not look good, but that is the seasonality in our business. That's why we look at year-on-year performance. And in terms of other businesses like global business, number of seats vary based on the how the mortgage market behaves. So there may be slight up and down, but that's more a stable business than anything else. So overall, a robust growth in terms of overall revenue. If you look at our EBITDA margins, you will see a growth of 41.5% year-on-year, and that's again led by operational efficiency and increase in revenue. While our expenses have also grown by about 21.7% year-on-year, but that's more because of the normal increment that you give in the beginning of the year, and the increase in IT expenses because of movement towards cloud, that we see the overall expenses going up in the first quarter. The realization of that, the corresponding revenue will happen in the subsequent quarters. So overall, PAT is a healthy growth of almost 57% year-on-year. And if you look at EBITDA margins and PAT margins, EBITDA margin has gone up by 315 bps year-on-year from 38.8% last year, same quarter, to 42% this year. And PAT margins have, PAT is, which was 23.9% in Q1 FY24, has grown by 476 bps to 28.7% in Q1 FY25. We are now having, strong cash and cash equivalent of almost 452 crores, which will be utilized towards the M&A that, we are working on. You will get to hear more as we come near to conclusion in terms of zeroing down the targets to foray into international market beyond Southeast Asia. And that is something which we are working on. The diluted EPS has grown by 57% year-on-year from 2.51 rupee to 3.94. And that's a reflection of the overall increased margin and the availability of, the operational efficiency that we have been working on. That's high-level financial performance. We are happy to take questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhijit S. from Kotak Securities. Please go ahead.
Hi, good morning, everyone. My first question is on the M&A front. We'll get more details as it kind of closes, but what sort of outcomes are you looking to achieve, both from a capability point of view and then also from a financial impact of the acquisition, let's say in the near term to, let's say, in the 2 to 3 year time frame?
Hi, Abhijit. Good morning. This is Shrikant. Let me take that. As we've impressed upon earlier on, we look at our M&A strategy from the lens of one of the 3 categories. One is a new geography, expansion or opening. One is adding a brand new business line, which we haven't been hitherto been in. For example, Hexagram is, one such acquisition. And the third one is consolidation in the industry. Probably a good example could be our acquisition of Sundaram BNP Paribas back in the day. We are, in terms of priority, we are looking at international expansion, followed by new capabilities, followed by consolidation as our priorities in terms of M&A. The current M&As that are currently under consideration and in focus and in discussion are largely on the international side. It is not a new capability addition as much as opening of a brand new geography with a significant addressable market where the incumbent has a sizable presence. Of course, some of these acquisitions, as we all know, can tend to take time with a series of regulatory approvals that are required to come through. Given the current phase at which we are in the discussions, we believe it's probably about a quarter to 5 months away, 4 to 5 months away. This acquisition, should it happen, we'll have, our acquisitions, if you see, have always been margin accretive and are opening significant addressable market. This too falls under the same category. We do not throw top dollars on a company just for the sake of acquisition. So until and unless the target acquisition adds value to our shareholders, we do not go ahead. So to that extent, from a financial standpoint, we believe it would be accretive to all the shareholders. And the value expansion from a top-line stand could be a decent profile, anywhere between 10 to 15% over our current numbers in terms of the annual top-line numbers and the bottom line.
That's helpful, Shrikant. And just one follow-up here. Given that you're looking for an international acquisition rather than a capability building one like Hexagram, the earnings accretion or value creation, would it be fair to assume that would largely be driven by, let's say, cost takeout or improving the operational efficiency of the business more than the revenue growth that you can add to the existing business?
I would say it is going to be both. Let me tell you why it is both. And of course, whatever you explained is anyway going to happen given the consolidation of that nature. Even from a value standpoint, there are very few administrators like us who tend to perform the end-to-end operation solutioning for any fund manager. That is, largely there are transfer agent players, there are fund accounting, fund administration players, and there are few pure tech and digital platform players. We are one of the few who have managed to deliver outcomes on all of these 3. So the target acquisitions we too are looking at are not necessarily ones who are currently like us. There aren't very many. So, for example, the target acquisition we're looking at is largely on the transfer agency. From a value standpoint, the Hexagram acquisition and the pure fund accounting solutions and the services capability we built over the last 3 to 4 years will be a significant opportunity for cross-sell and upsell to the clientele. So the addition of revenue aside, all of that clientele will give us a significant opportunity for us to expand the business services, including the value added and the tech play for those clientele. I hope that answers.
Got it. Thanks a lot.
Thank you. Ladies and gentlemen, before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Supratim Datta from Ambit Capital. Please go ahead.
Thanks for the opportunity. So my first question is on the mutual fund business. And now, on the slide 11, you have mentioned that there is one data lake contract from a large AMC, and there are two AMC clients who have signed up for the digital assets contracts, and both of them have happened in July. So just wanted to understand when would these revenues, hit the P&L, and, what kind of size contracts would these be? If you could give us some color on that. That's the first point. On the second one, again, on the international business, you talked about the M&A opportunity and the timelines. Just wanted to understand that, when it comes to the size of this acquisition, what kind of size, are you comfortable with when it comes to acquisition? And two is, would you look at only financing it through your own balance sheet, or would you look at other forms of, financing as well when it comes to this acquisition? Those are the two key questions, and I have one more, but I'll follow up after you answer.
Certainly. Thanks for the question. So the tech contracts that we are speaking about, the revenue when it will kick in for two of the three contracts, the milestones have already started to kick in. All of these contracts are milestone based. Some at the signing time, some at the development, some at the testing, so on and so forth. So two of those contracts have already started, and revenue will start to kick in into this quarter. The third contract is going to start into the coming fortnight. So net in the quarter two, all of these three contracts, certain amount of revenue would be clocked based on the certain number of milestones being reached. And all of these contracts carry annual maintenance and a change contract-driven revenue as well, which means that it is going to be recurring in nature literally every single month from here on. In terms of the M&A, broadly to again explain the size of the contracts. So the size of the contract is again a factor of course, the opportunity it presents to us. If you saw a profile, we haven't been big, big M&A buyers in terms of significant amount of enterprise value being given on the largest M&A we've done was roughly about 80 to 90 crores broadly, right? But the international, as you look, we need to expand our war chest a little bit more. While there are opportunities and this space is consolidating globally, not just here in India as well. Our sweet spot is anywhere around $50 to $75 million, and of course, smaller the better. But at a $50 to $75 million, as you could imagine, that easily could be financed with our own internal accruals. As Mr. Vivek had already explained, today we are probably looking around anywhere between 450 to 500 crores, which would take care of the size of the acquisition we're looking at. By the time the acquisition would conclude, we would have generated that much more cash so that we do not need to leverage. But should we ever need to, we can. And obviously, we are a debt-free company at this point in time. If an opportunity presents itself, that we need to strike a little bit of balance on the leverage, even to increase the shareholder returns. We would happy to do that. Just in terms of as I said, the target acquisition that we're looking at in terms of addition to the revenue profile, it could be anywhere between 10 to 15% of our target revenue for the end of this year.
Got it. Understood. That's very clear. Just one follow-up. If you could give us a breakdown of the international other business, what has been the growth in the international versus the EIF versus the NPS? If you could give us a breakdown of that would be very helpful.
Yeah, I'll take that, Shrikant. So on the GFS side, if you look at Q1 FY25, it's about, as of now, it's about 3% of the overall revenue, 3.5% of the overall revenue. Pension is about 1% of the revenue. AIF, PMS, PWM is about 4% of the revenue. Hexagram and Webile is around 3% of the revenue. So that's the composition. It has moved up overall in terms of international other investor solutions from an overall 10.5% of the total revenue last year to about 11.5% this year. So this is the high level breakup.
Got it. That's very helpful. Thank you.
Thank you. The next question is from the line of Pranuj Shah from JP Morgan. Please go ahead.
Hi, thank you for the presentation. I had a question on your issuer solutions piece. Obviously, the revenue growth at 22% has been quite strong. So what could be the sort of uplift that you would expect if, suppose, Hyundai and Bajaj Housing do complete the IPO this year. I think previously you had guided for a mid-teen growth in issuer solutions revenue on a steady state. So would these IPO proceeds be additional and on top of that for the revenue growth profile for this year?
Yes, the answer would be yes. I think, from a mid-teen of the investor services, we are looking to mid-20s, early 20s to mid-20s growth profile this year. Not just the new IPOs, which of course give us a little bit of kicker in that year's revenue, but as we all know, these are all annuity contracts. Obviously the subsequent years, in fact, will give us even more revenue, given it will be a full year revenue as against a part year revenue that we'll get this year. So not just those two, there are at least about 30 plus IPOs that are, about to go live into the coming quarters based on the RHP filings that we have seen and, the mandates that we've won, not just this year, but the previous year and one before as well. And the demerger of ITC, et cetera, all of them will provide immediate, revenue source. And what's even more heartening for us is obviously the continued expansion of DMAT and the retail folios. As we all know, the revenue component of corporate registry is innately tied to the number of retail folios. And, the IPOs will definitely be, icing on the cake over the expansion of the DMAT itself.
So Srikanth, just to confirm, you said mid-20s sort of revenue growth excluding these IPO revenues, right?
No, not excluding, all of it together.
Okay, understood. So 20 to 25% including the IPO revenues. And I think in that context, do you still maintain that up to 45% EBITDA margin? I know like in this quarter it has come off, but I think Vivek mentioned that was due to increments and some big expenses being front-loaded. So how do you see this trajectory for rest of the year and possibly also for FY26?
I think probably I need to demystify a bit about the Q1. This quarter at near about 42% EBITDA margin is probably the highest Q1 that we've ever had. Right?
Yes.
And if you saw last year, it was 37%. The year before that, it's usually sub 40, the Q1, because what happens in Q1 is typically your businesses of largely, let's say if you take mutual funds, for example, the AUM as of 31st March and 1st of April is going to be practically the same. There will be a little bit of modest gains, but you see that suddenly your entire wage and the other tech contracts, which too are also tagged to the fiscal year, they tend to go up, right? So let's say and hence there is usually dip, and also Q4 also is a big quarter for issuer solutions in terms of the corporate actions. Some of the historical one-time revenues that tend to kick in for any big tech and delivery revenue that happens. Many of those usually won't be there in Q1. In that context, a 42% EBITDA margin in Q1 is basically, should give us a significant insights in terms of where the rest of the quarters could be. If you compare last year, at 37% start in Q1, we ended the year with near about 44%. So we expect it to be a significantly better year. But of course, as we have always been maintaining, we're not necessarily chasing 150 basis points of margin as much as the growth, and the growth will continue to come in a differentiated manner as we continue to reinvest in technology transformation, new geography expansion, new asset class expansion, so on and so forth. So, but broadly, yes, we do expect the revenue profile, to be, far higher compared to that was in the previous year.
So also in the EBITDA margins, I think you would be trend higher than what it was for FY24?
Yes.
Okay, got it. Understood. Thanks.
This is Vivek. I just want to, reiterate our guidance on EBITDA margins. It remains in the range of 40 to 45% as of now, because we have to see sustainability of enhanced margin. Market is doing well. We are expanding in global market. But as I had mentioned earlier, and we have reiterated that moving out of the 45 to 50% range, from the current range of 40 to 45, will, in terms of sustainability, we'll have to see a period of time of at least couple of years before we start moving our guidance beyond 45%.
Perfect. Got it. That's very clear. Thanks, Vivek.
Thank you. A reminder to the participants that you may press star and 1 to ask a question. The next question is from the line of Sai Aditya Menon from Avendus Spark. Please go ahead.
Hi, good morning. Thank you for your time. Couple of questions. The first one would be that the yield is compressed from 3.72 bips to 3.66 bips in over the last quarter. You had mentioned that there are some contracts that were renegotiated at the beginning of the year. Any more color that you can provide on this? My second question is on the international business segment. Any update on the overall 20 million guidance, and has Thailand specifically gone live? And has it started adding to the top line yet? Third question would be around ESOP cost. ESOP cost for the full year FY24 was 2.6 crores, and in 1Q it was 3.11 crores. So will this be the new normal? If I can squeeze in other questions, I'll squeeze it in later.
Sure. Let me take that. I think the first question in terms of the yield compression, it is marginal, especially in the context of the negotiation, that had already been concluded. So clearly our top line growth, is after making into account the contract that had been renegotiated. Almost all our large contracts have been renegotiated as of 1st of April this year. So we do not anticipate significant compression, except, of course, what may come through in the form of any big changes in the form of the telescopic pricing kicking in. Right now, that obviously means that if the AUMs are growing substantively faster in a significantly bigger manner, there could be some yield compression, but that comes to obviously a significantly better news in terms of much higher revenue profile as the AUMs, go well beyond thresholds that we have at the moment. In terms of the international, the $20 million was the pipeline, and it continues to be steady and growing. I had called out about, one large contract that had been signed up, and another one we are anticipating to receive anytime today or tomorrow, even though the draft letter of award had already been given to us by our client. These two are decent-sized contracts and materially sized contracts in the context of the global fund services. Roughly anywhere between 1.7 to $2 million of revenue, in the near term, followed by little about $750,000 revenue to come through on an annual basis, excluding any change request-driven revenue that we will get over and above that. Now, these are the deals that have pretty much materialized, and we continue to chase down the rest of them as the market conditions have significantly improved in the Asian markets this year as compared to that of the previous year, including the appetite of many of these conglomerates willing and wanting to outsource to administrators such as us. We had, in the month of May, conducted a conclave, including inviting the regulator in Malaysia that was received exceedingly well by the local industry. That has also opened a series of doors for us, apart from culmination of the contracts that I'm talking about. We intend to conduct similar such sessions in multiple other geographies later during the year, which we are confident will also deliver similar such results. On the ESOP piece, I would let Vivek cover, but broadly, in line with our strategy to have top talent retention and a very committed workforce which continue to outperform in every aspect of it, wealth creation for our employees is as critical as it is for our shareholders. And we have given a certain number of stocks to critical performing employees. Of course, the year one hit would be higher and it would taper down over the years, but the philosophy in terms of long-term wealth creation for our employees would continue to be there. Vivek, anything you'd like to add?
Yeah, thanks, Shrikant. So just to add to what Shrikant mentioned, the current ESOP pool is exhausted with this last grant. There is a new ESOP plan for which we will approach the shareholders for approval, and then the exchanges before we create a new ESOP pool. And basis that whatever you are seeing is obviously in the first year when you take the hit for the new ESOP grant, it is higher. But coupled with the new ESOP pool that is getting created, it may slightly go up in terms of about for the current year, you can assume about 15-16 crores of full year hit. And next year onwards, it may be slightly higher because there will be new ESOP pool, there will be new ESOP grants to new talent that we are acquiring in the international territory as we do acquisition and we employ more people to attract and retain talent. So it may be marginally more next year, but this year it will be around 15-16 crores.
Thank you. If I can squeeze just one more question. On the issuer solutions part, folios per company was higher in this quarter, but we see the revenue per folio has come down. How do you see it for the entire year? Or has something changed structurally, or is it part of the cyclicality?
I'm sorry, I didn't get the specific point. What has reduced as per you? Sorry. Revenue per folio.
Revenue per folio has slightly come down, but number of folios per company has increased. So just wanted to understand that bit.
Yeah. So again, it's if you extrapolate the logic, it would be slightly akin to that of even asset management business, isn't it? I mean, when you have for certain clients and certain corporates, in the case of issuer solutions, the retail folios expand dramatically for some of the clients where, let's say, the unit pricing is slightly lower. There is a marked difference between asset management and corporate services, right? In the case of the AMCs, the yield numbers are pretty tight bound range, very narrow range, right? Depending upon which clients and pretty much almost all the clients. Whereas in the case of issuer solutions, the unit price can be quite significantly varying. For some clients, it could be as little as 6-7 rupees. It can go all the way up to 30-40 rupees as well. So it is literally a factor of which of the corporate that, of all the, literally 6,000 clients we have, has had a significant retail expansion. And if some of them happen to be the ones where the unit pricing is slightly lower, it tends to obviously have an impact on the overall numbers. So that is just, an aberration which corrects itself rather quickly because there is no one company in India where it will continue to have a significant market value share retail participation as compared to somebody else. So it can be a sectoral movement, it can be thematic, it can be cyclical, it can be anything at all, company's performance, so on and so forth. So I think what's important is definitely the folio count expansion. The other advantage we have in the case of issuer solutions again is the prices tend to go up. So there is a repricing that we have. Every year we follow that, and certain number of clientele actually move from point A to maybe 1.08 or 1.10. That is basically 8 to 10% unit price expansion also happens in this particular line of business, which we expect to see happening into the coming quarter.
This is Vivek's side. Just to add to what Shrikant mentioned, if you look at our Q1 FY24 average folio fee was 7.3. It has gone up to 7.5 now in Q1 FY25. If you are comparing it with annual 9.4 average coming down to 7.5, that may not be the right comparison, because at the end of the year, it will hover between 9 to 10 rupees only. So, there are various components in the corporate issuer solutions besides the folio income. There are corporate actions, there are value-added services, which increase the average folio fee as you go along future quarters, because most of the companies declare dividend or bonus or rights or AGM related revenue in Q2, Q3. So you will see an uptake in the average fee quarter after quarter, but it won't go down from 9-10 rupees on an average on an annualized basis.
Thank you. Understood. Just last one. Any communication on further paring of the stake by General Atlantic that has been communicated, or any plans as such?
No such plans, no such communication has been received. This year there has been a small paring down, and our shareholders' commitment and their interest in our business continues to be as good as it was in the past 7 years.
Yeah. So having said that, General Atlantic is actually a PE, so and they have evergreen funds, does not mean that they will not give returns to their investors. So it's their choice. I don't think it impacts us in any way as a company. It's a company which is professionally run by a professional board and professional management. So I don't think there should be a concern in terms of GA choosing to dilute further.
Very helpful. Thank you so much.
Thank you. The next question is from the line of Uday Pai from Investec. Please go ahead.
Thank you for giving me the opportunity. Two questions from my side. First is, how is the EBITDA margin in the international segment for this quarter? And secondly, in your opening comments, you mentioned that phase 2 of the Thailand contract is expected to go live in this quarter. So any color on the incremental revenue that could come from that contract? Those are the two questions.
Sure. Yeah, great. You want to take that?
Yeah, I'll take that. So international business continues to be hovering around 30-35% EBITDA margins. And as you know, Shrikant mentioned that as the new deals, which are large deals, get fructified, this will improve further. While our average bips on the AUM continues to be higher than what we get in India, we will continue to get EBITDA levels surpassing what we have in India. As we become more, as we become larger in terms of scale. So it's 5.2 bips versus what you see 3.6 bips in India.
And secondly, on the incremental revenue from phase 2 of the Thailand contract?
Yeah, I can take that. The phase 2 is expected to go live late September, subject to the UAT and the clearance from the fund management house. It was roughly a 12 crore contract, and about a third of that had been booked into the phase 1. And the rest of it would be booked in post go live. And there is a small component of that is reserved into the subsequent year in terms of the phase 2 part 1B.
Okay, thank you.
Thank you. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good morning, sir. So just two questions from my side. First, on your domestic alternate RTA business, when I look at your revenue yields, whether I look at it on per fund basis or on an AUM link basis, that has been increasing for the past few quarters. So just wanted to get some sense of the reasoning behind it and how should one think of it going ahead. Is it more of a new fund acquisition-led sort of any upfronting, or is it more structural in nature? Second, on your international business, while you have done quite well in your Malaysian market, in some of the other Southeast Asian markets, I mean, the number of clients have broadly remained stable, at least on the RTA part of the business over the last almost 12-18 months of barring one or two wins here and there. I just wanted to get some sense of your non-Malaysian geography targets or ramp up. You mentioned you'll be organizing some events in some of these markets. So just wanted to get idea about the traction that you expect in some of these markets over the next year or so.
Sure. I think on the domestic RTA, expansion, it's actually a structural, growth. There isn't any, one-time exotical item that is changing anything here for us. I think it is the quality of the clientele we have, and the single biggest advantage that we have in this space, of course, is presence of several clients who are growing faster than the industry, right? I mean, it's not a concentrated growth of few asset management companies, and this is what helps us to keep our yield higher. This is what keeps us, certain amount of downturns that may happen if one or two odd fund houses, tend to hit, performance hurdles every once in a while, right? I mean, there is no one scheme or one AMC that can continue to deliver, superior returns as compared to the industries over a long period of time. So when that churn happens, more often than not, we tend to be the beneficiary of that, and that's what's reflecting in our, overall growth, and which is structural in nature. For example, if you see the Q1, the overall AUM market share of KFin clients had been about roughly 41.5 as against 37 previous year. And that's a big gap in terms of nearly 400 basis points, over the market. In terms of international, the two large clients that we have signed up this year, both are in Malaysia, as I just said, and both were pretty much in the last 4 to 5 weeks. And Philippines offers a very interesting proposition for us. You're right in your observation that we have only added one large client, that was Bank Islam last year in Philippines. But that said, the market in Philippines is relatively, smaller as compared to Malaysia for that matter, right? And hence, rightfully so, our efforts are concentrated in geographies where there is a higher opportunity. Thailand offers, pretty good scope, and that's where we could break into it, and that too with one of the top 3 bank-driven asset management companies in Thailand, and that positions are well for several of the others. As I mentioned earlier too, the international contracts, the cycle time in terms of signatures tend to be a little bit more protracted. Given these are not necessarily driven through RFPs, so on and so forth, these are the wins that we are orchestrating by impressing upon the outcomes we could deliver. There is a latent inertia, and I would always equate this to pretty much where Indian IT outsourcing was maybe 2 decades back, where you had to convince a client the virtues of outsourcing and just as importantly, how offshoring would help. And either of these two are pretty easy conversations to be had. But once you gain the momentum, as we have done in case of Malaysia, and as you could see the sequential number of client wins that we've been having, the same would be replicated across all geographies. Now, I'll specifically cover Singapore and Hong Kong, where we had clients, but then again, your observation that we haven't had too many more. Yes, last year we had one mutual fund syndrome mutual. We have one in Singapore. We have also recently signed up with Manulife in Singapore, in addition to the Hong Kong that we've already had. But it needs to be understood that Singapore and Hong Kong are predominantly alternatives markets. They are mutual fund markets, but predominantly alternatives. And we had to have a solution which would be, rivaling that of the current incumbents, right, in the case of alternatives. Now, the acquisition of Hexagram and hence, inheriting Empower, combined with the Exalt platform we created and launched in the month of March, I called this out in our annual, investor conference, basically now has given us the ability to deliver alternatives, which is far more bespoke in nature and non-linear as compared to mutual funds. And hence, the event that I'm talking about, the one we've done in Malaysia in the month of May, we are replicating, something similar in Singapore and Hong Kong in the coming quarters, would be to attract a sizable number of fund managers, especially the PEs and the hedge funds and the VCs. They are going to be my target clients, a little less of mutual funds, if I may, right? So you would start seeing traction there. If you saw Indian alternatives for us, we have moved from about 100 in about 4 years back to today managing near about 500 funds, right, having a market share of 37%. And that happened because we created a platform and a service line integrated TA-FA. Now, similarly, it had to be done for Singapore and Hong Kong, which is what was completed as of the month of February, March when we launched it. So you would hear a lot more about these 2 geographies into the coming quarters.
Sure. Just one small follow-up. Having doing an inorganic acquisition in Malaysia way back in time, and then scaling up the business versus let's say organically building the platforms or kind of leveraging on the platforms in some of the geographies, and then kind of trying to target clients in a new geography like you said to Singapore and Malaysia, Singapore and Hong Kong. Do you think is there an inherent difference in the scale-up strategy between these 2 strategies? And on that point, the acquisition that you're talking about on the international front, is it linked to this similar sort of a hypothesis?
Yes, one could easily argue that what we've done in Malaysia is what we ought to be replicating elsewhere, and believe me, that's what we intend to do as well. But that said, we can't be all hoping and praying that an acquisition would happen in every target country. It is not every time it is possible, not every place you have a like-to-like target acquisition that we can look at, and not everybody is looking to be acquired either. So we are looking to buy versus build kind of a strategy as always. But in international, we have to continue to build our organic way to expand whilst continuing to look at an acquisition. So short answer to your question here, the acquisitions we are looking at are in the geographies where our present needs to be expanded, especially in the ones that I just spoke about. While that happens, we are not going to stop or basically not going to keep waiting, for the acquisition to happen. We will build our capabilities simultaneously as well. What happens is that there would be a convergence. Even in the case of Malaysia, if you would recollect, while we have done the acquisition, we had still taken our India's platform and repurposed it for that geography, right? And scaled up our solution because that is the right way to expand into international markets rather than just stitching a collage of 10 different acquisitions over a period of time, and that would significantly impact the operating leverage and the technological leverage that you would have. So short answer, we continue to look at acquisitions in those same geographies as much as we're continuing to build out a platform, because we have to do it either before or after. That is not an option.
Got it. So thank you and all the best.
Thank you.
Thank you. The next question is from the line of Sanil from ICICI Securities. Please go ahead.
Hello. Good morning. Good afternoon, sir. Thank you for the opportunity. So my question is regarding the new asset class which SEBI has just said. I mean, no, it's very early days, but do you see a significant opportunity from a RTA side or the back-end side of it? And do you think that since you have such a tech capability on the AIF side, do you think this can grow into a very good opportunity, as well as do you think that, since it's a different product or asset class, do you think a new contract would be needed on this asset class?
Great question, and the short answer to all of those is yes. Of course, every new asset class provides itself an opportunity, for us to grow and expand. And obviously, it's still very early days in terms of the contours and specifics, but we are very confident that it would emerge. Obviously, the regulator is keeping in mind the gap that exists between the mutual funds, PMS, and AIF in terms of the thresholds are, quite large. Keeping in mind the income variation, at least at the middle class level isn't as significant. So from that standpoint, the new asset class, we believe, could provide a very, very interesting via media opportunity for several more people to invest and take a slightly higher risk profiling as compared to MF, but much lesser risk profiling compared to PMS and alternatives. Yes, of course, we will have to create the solutions, that befit such an asset class. As we know, all of these financial asset classes necessarily need to go through, will have a spin in the case of a registrar and transfer agent, and we are one of those. And given we are there both in the issuer services, that is the securities and the bond markets, as well as in the mutual funds, alternatives, PMS, one way or the other, we will have a role to play in that, right? And not to mention, there is a renewed focus and a significant focus in the form of both the government of India and the regulator to drive the REITs and the InvIT market as well. And we are currently working with the regulator to create a solution for the REIT market, which hopefully will go live in probably into the coming quarter.
Thank you, sir. Thank you for the response.
Thank you. The next question is from the line of Abhijit S. from Kotak Securities. Please go ahead.
Hey, Shrikant, thanks for the follow-up. See, on the domestic alternatives business, I think that's a very fast-growing business for the entire industry. But in terms of pricing, I think we are broadly at about 3 to 4 basis points. So my question really is, two-part. One is that, do you think, that's where the market will settle in terms of pricing and the actual pricing levels? And second is that in terms of competition, like we recently saw, SFNC also setting up a India front office in GIFT City. Do you think over a period of time that can come under pressure because of the growth in AUM itself? Thank you.
Thanks, Abhi. To the first question, 3 to 4 basis points is a pretty reasonable number, for the Indian alternatives in the context of the scale. I'd be very happy if it settles, anywhere near 4 at the higher end of the threshold. Internationally, of course, the numbers are much, much higher. They range anywhere between, 7 or 8 all the way going up to 20 also in many cases, depending upon the size of the fund and the domiciliation you're talking about. So that's that. And, given we are the only RTA who does both TA and FA at scale, our revenue is not just at a fund level, but also it is both separately for TA and separately for FA, right? Otherwise, broadly for the other players, it would be lesser than the 3 to 4 basis points you're talking about. Second, many international fund administrators are setting up bases in India is natural. It's not just SFNC, you have IQ, EQ, you have FX, partners, and potentially a few others as well. They have all been in India for the last bunch of years, largely to take care of the captives they have set up in India to support their international operations. Many, if not at least many, some of their current clients internationally are also obviously exploring GIFT City as a possible fund structure route. And as they set up, their clients obviously would nudge the current fund administrator, to be able to support them as they expand into the GIFT City operations. That said, if you see the total contract wins in GIFT City, we have nearly 60% of all the GIFT City funds being managed by us. We recently also signed the first and the second insurance-based fund that is listed in the GIFT City. Now, when it comes to pure domestic alternatives to be supported by any of these fund administrators, we don't want to be arrogant and thinking that others will not join the party. I'm sure they will. But our advantage lies in significant amount of localization of the platform and a cost to serve, which will be very, very hard for others to match and beat. So to that extent, whilst we continue to obviously keep a watch on the overall expansion of the service provider ecosystem, we believe that we have significant number of modes, and the modes that are continuing to get better by the day, and hence we are more confident to grow faster in the coming years as against otherwise in the context of new competition emerging.
Very helpful. Thank you.
Thank you. The next question is from the line of Amit Agicha from HG Hava. Please go ahead.
Good morning. Am I audible?
Yes.
Yeah, thank you for the opportunity, and I congratulate the committee for commendable performance in the past 1.5 years. From the IPO date till now, the value has doubled almost, and I appreciate this. And my question was regarding the reduction in the promoter holdings.
Mm-hmm.
My question was regarding the reason for reduction in the promoter holdings.
Certainly, I think Mr. Vivek had already answered that, and I can ask him to add a little bit more color. Our promoter is a private equity. A private equity's fundamental job is to deliver returns to their shareholders and their investors. And in that context, anyone who has invested a substantial chunk is expected to downsize over a period of time, right? But this company is a professionally led board, managed by professionally led board and a professionally led management to that extent. It's been nearly 7 years since General Atlantic had been there, and they've been an exceedingly wonderful partners for us, and they'll continue to be there for a foreseeable future, even as one may expect, some blocks to be sold over the next, bunch of years.
Understood. Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to Mr. Devesh Agarwal for closing comments.
On behalf of IIFL Securities, I thank the KFin management for giving us an opportunity to host the call today. Before we conclude the call, would the management like to add any closing remarks?
Nothing at my end. We continue to focus on what we do best, which is to deliver value to everybody in the stakeholder ecosystem. So I think in the context of the new signups and the optimism that we are seeing across our current clients and the prospects, we hope to deliver higher value as compared to what we have over the past bunch of years. Thank you so much for joining.
Okay. Thanks, Shrikant. Thank you everyone for joining the call today. Siddharth, you may now conclude the call.
Thank you.
On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you, Devesh.